You've probably heard hedge funds described as where the real money is made, insane returns, billionaire managers, and exclusive strategies. But here's the real question that nobody answers. If hedge funds are so good, why can't retail investors like you and I get access to them? When I first started investing, I assumed hedge funds were totally off limits, and simply put, because I wasn't rich enough. And although there is some truth to that statement, there is ways you can get involved in similar strategies to support your investment returns potentially. And it got me thinking, because retail investors, you and I, we put our money to work, we put it into risky stocks, so to speak, into overall markets, yet hedge funds are still locked away behind closed doors, only reserved for institutions and ultra high net worth people to essentially help them get richer over generations. But here's the thing that most people, including myself, completely overlooked. Hedge funds aren't banned because they're better. They're restricted because they're less transparent, lightly regulated, and hold a lot more risk. And once you come to terms and you realize that, you'll understand that you don't need access to hedge funds to get access to hedge fund style strategies, which we'll go into a lot more detail on today's video. Now, with that being said, in today's video, we'll be talking about why retail investors can't invest in hedge funds, and more importantly, how you can get similar exposure without taking excessive risk across your portfolio. We'll also be discussing whether investing in hedge funds in general is worth the reward considering the amount of risk that you take. And as mentioned, all the ETFs that we'll dive into will be linked down below in the description so you can have a look for yourself. And when investing, your capital is always at risk. I'm not a financial advisor. Everything that I'm sharing is just from my opinions and my findings. Now, to understand why hedge funds are locked away from retail investors, we need to understand the nature and the makeup of a hedge fund. And by their natural nature, they are a private investment vehicle. That means they don't have to follow the same strict regulations as a mutual fund or an ETF, as an example. And again, this is assuming that they accept accredited and experienced investors, which basically means that these people understand the risks of investing and they're not essentially novices. They're putting money into these funds that they can afford to lose, and it won't have a detriment to their overall financial position. And there is qualifications that you need to pass essentially to be allowed into this cool fancy club, so to speak. And that is typically a net worth of over $1 million that excludes your home, or an income of at least 200k per year. And essentially it doesn't matter how smart you are, or if you've got, a PhD, for example, you have to essentially meet financial rules that allow you to get access to these funds. And even then, you might not be accepted into specific funds because every fund has specific requirements that you have to meet. Minimum commitments to these funds, so investments into these funds, can look from 100k on the smaller end up to $1 to $5 million for the most exclusive funds, so to speak, and every fund is slightly different. But these funds will typically want to work with people that have more money because they can sustain any drawdowns that the hedge funds go through. Not only that, capital, your money that you invest into these funds, is locked up for periods of time, often years, that you won't be able to just get your money back whenever you want. So this essentially puts more risk on the person making investment into that fund, because if you don't and you need that money, you won't be able to get access to it. It's completely different to a traditional investing into an ISA, because you still have access to that capital whenever you want. Whenever you give it away to a fund manager, they have autonomy, so to speak, over that money that you've committed to that person. Liquid alts, or liquid alternatives, are investment style funds wrapped within mutual funds or hedge funds that allow retail investors like you and I get access to hedge fund style strategies. Now, some of the strategies they expose us to, obviously it depends on the specific ETF or mutual fund you're looking at, but this can include long short equity, event driven strategies that tie in different macroeconomic factors, as well as derivatives and futures, which are inherently risky by nature. But unlike traditional hedge funds, these are a lot more liquid, so you can buy and sell into them like you would a traditional ETF, and there's a lot more regulation around these funds too, so they're much more transparent for the user getting involved. Now, as they're not traditional hedge funds, they will be less aggressive just in nature, but it's important not to discredit the holdings that they have within their specific ETF, which can be interesting to have a look nevertheless. So right off the bat, we can see we have the iShares Systemic Alternative ETF, which is actively managed. So the manager will add and discard trades, so to speak, within this ETF as time goes on. So first of all, we can see the year-to-date return is just over 2.4%, which you could say is good or you could say is bad, but when we want to scroll down and look at some data, we can see it's a new ETF. So we can't really benchmark what happened last year because we only have data for this year so far, which is quite interesting. And we can get a little bit of an understanding of why you could invest into this ETF as a broad overview. So we can see the investment objectives. It's more focused on the long-term time horizon, which for me aligns with my goals too, because I'm a long-term investor. However, what is a red flag? Well, not necessarily red flag, but something to take note is the expense ratio, and that is at 1%. And when we benchmark that compared to an S&P 500 or an all-world ETF, it is very much more expensive. So it depends if I want to take on that risk and increase my fees essentially, and we want to keep our fees as low as possible. Now, scrolling down, we can see it's a multi-asset fund. It invests into cash equivalents. When we can see here, they invest into treasury bills. There's some equities in there as well, but it's predominantly focused on derivatives, which by nature is much more risky and a lot more confusing as well. I tried to invest in derivatives once and it just went straight over my head. So that's why I stick to stocks, to be fair. Now, looking at it from a geographical perspective, most of it is exposed into the US. There's a tiny bit in Canada, and we have some small parts into the UK. And looking over the asset class, we can see again, most of it is within cash or derivatives, fixed income, so debt, and there's a tiny piece there into equities. Now, what's quite interesting here, we can actually see the portfolio managers, and you can do more research on this guy. We can see if he's had good returns on, in his previous days. We can see he was the CIO and head of systemic equities, member of BlackRock's global executive committee, which again, you can read up and see if he has been successful, what he likes. And these guys in the team are driving the returns, so you're invested into those guys too. Not only that, we can also see different product briefs if you wanted more information too on the strategy. But it's definitely a good way to get an understanding, get a bit more of an understanding why these people have created this ETF and the overall goal of the ETF too. So again, I'll link it in the description below if you want to have a look for yourself, but it's definitely an interesting one. But for me, the big question is, do hedge funds overperform? Do they beat the market? Are they a good investment, so to speak? And the short answer is no. When compared to a broad index like the S&P 500, hedge funds have shown that they traditionally underperform the benchmark, and this is especially true once you consider their high fees in nature. But there is a counter argument to this, because hedge funds, so to speak, say that their goal isn't to outperform the S&P 500. Their goal is to create something called alpha, which basically means reward over the benchmark like the S&P 500, or to protect capital during intense crashes in markets, because they'll be trading in different ways to the market. Now, in 2007, Warren Buffett made a simple bet, $1 million bet, that investing into an S&P 500 index tracker would be 5 grouped hedge funds over a 10-year period. Now, the result, the S&P 500 averaged 7.1% per year, whereas the hedge fund averaged 2.2% per year. And the massive difference between these results were the massive fees that the hedge funds were charging their clients essentially. Hedge funds typically take 2% management fee and 20% of overall profits, and this alone will eat into your returns like no other, whereas the S&P has much lower fees. There is no profit sharing with the index manager or the ETF manager, so to speak, which drastically impacts results over time. Now, if I was to wrap out and tell my younger self, are hedge funds worth it? Should I be wanting to invest into similar strategies and trade in derivatives, for example? I wouldn't be so worried, right? Sometimes simpler the strategy, the better, and we don't need to get involved into so-called exclusive strategies to make good money and make good returns. As we can see, the data shows that isn't always golden on the other side. But with that being said, if you was curious to look at hedge funds and get involved in strategies, there is ways around it that you can get involved in as a retail investor, which is quite interesting. But with that being said, guys, I hope you enjoyed the video. Let me know your thoughts in the comments, and I will see you on the next one.